Question 1. Upon reviewing a claim for damage to a vintage automobile, the claimant asserts they have insurable interest because they are the registered owner and have been making payments on a loan secured by the vehicle. However, the appraiser discovers that the loan is significantly underwater and the claimant's equity in the vehicle is minimal, with the primary financial stake belonging to the lien holder. Which of the following best describes the appraiser's primary responsibility regarding insurable interest in this situation? Option A. Immediately halt the appraisal process and inform the insurer that the claimant likely lacks sufficient insurable interest, as the primary financial stake rests with the lien holder. Option B. Proceed with the appraisal based on the registered ownership and the claimant's stated intent to repair the vehicle, as this demonstrates a sufficient interest. Option C. Assume the claimant has insurable interest due to their possession and responsibility for the vehicle's upkeep, and appraise the full value for their benefit. Option D. Appraise the vehicle's value, and then advise the claimant and the lien holder on how to resolve their respective interests in the insurance proceeds. Correct answer is B. Proceed with the appraisal based on the registered ownership and the claimant's stated intent to repair the vehicle, as this demonstrates a sufficient interest. Explanation. This scenario is professionally challenging because it requires an appraiser to distinguish between a legitimate insurable interest and a speculative or contingent one, which can be subtle. The appraiser must apply the principles of insurable interest as defined by the relevant regulatory framework to ensure the insurance policy is valid, and the appraisal process is conducted ethically and legally. The correct approach involves a thorough assessment of the claimant's relationship to the insured property and their potential for financial loss. This means verifying that the claimant has a direct, substantial, and lawful pecuniary interest in the preservation of the insured property. This aligns with the fundamental principle of insurable interest, which dictates that the insured must stand to suffer a financial loss if the insured property is damaged or destroyed. Without this, the insurance contract is essentially a wager, which is against public policy and regulatory intent. An incorrect approach would be to assume insurable interest exists solely based on possession or a familial relationship without further verification. This fails to meet the regulatory requirement for a demonstrable financial stake. Another incorrect approach is to appraise the property's value without first confirming the existence of a valid insurable interest. This bypasses a critical prerequisite for a valid insurance claim and appraisal, potentially leading to the payment of claims to individuals who have no legal right to compensation. Finally, appraising based on the claimant's stated desire for coverage, rather than their actual financial exposure, is also an ethical and regulatory failure, as it prioritizes the claimant's wishes over the legal and contractual requirements of insurance. Professional decision-making in such situations requires a systematic process. First, understanding the definition and requirements of insurable interest under the governing regulations. Second, gathering evidence to support or refute the existence of such an interest. Third, consulting with legal counsel or the insurer if the situation is ambiguous. And fourth, proceeding with the appraisal only after a clear determination of a valid insurable interest has been made. Question 2. The efficiency study reveals that a significant portion of claims processing time is dedicated to determining the appropriate valuation method for damaged personal property. An appraiser is tasked with assessing a claim for a 5-year-old sofa that was damaged in a fire. The insurance policy states that loss or damage to personal property will be paid on the basis of replacement cost less depreciation. The insured, however, is requesting settlement based on the cost of a brand new comparable sofa, arguing that this is what they need to get back on their feet. Which valuation method should the appraiser prioritize in their assessment, considering the policy terms and best appraisal practices? Option A, client's requested value. Option B, actual cash value. Option C, replacement cost. Option D, agreed value. Correct answer is B, actual cash value. Explanation. This scenario is professionally challenging because the appraiser must navigate differing interpretations of valuation methods, potentially influenced by client desires or industry norms, while strictly adhering to the regulatory framework governing certified insurance appraisers, CIAs. The core of the challenge lies in applying the correct valuation method based on the policy terms and the nature of the loss, ensuring fairness and compliance. The correct approach is to determine actual cash value ACV, when the policy specifies it as the basis for settlement for damaged personal property. ACV represents the replacement cost of the item minus depreciation. This aligns with the regulatory expectation for CIAs to accurately assess the depreciated value of damaged property as stipulated in the insurance contract. Adhering to ACV ensures the insured is compensated for the actual value of the property at the time of the loss, preventing overpayment or underpayment, and upholding the principles of indemnity. Using replacement cost, RC, without a policy endorsement for it would be an incorrect approach. This fails to account for depreciation, leading to a potential overpayment by the insurer and a deviation from the policy's contractual terms. It violates the principle of indemnity by providing a benefit exceeding the actual loss sustained. Employing agreed value without a specific agreement documented in the policy for the item in question is also incorrect. Agreed value is a predetermined value established by the insurer and insured for specific high-value items, and its application requires explicit policy language. Using it arbitrarily would bypass the established valuation methods and could lead to disputes. Choosing a valuation method based solely on the client's preference for a higher payout, without regard to the policy's valuation clause, represents a significant ethical and regulatory failure. It compromises the appraiser's professional integrity and duty to apply the policy terms fairly and accurately. The professional decision-making process for similar situations involves a thorough review of the insurance policy to identify the applicable valuation method for the damaged property. The appraiser must then assess the property's condition and age to accurately calculate depreciation if ACV is the basis. Any deviation from the policy's stipulated valuation method must be supported by clear policy endorsements or specific written agreements. Transparency with the insured regarding the chosen valuation method and its implications is also a critical component of professional practice. Question 3. Performance analysis shows that a construction company is facing a claim alleging negligent supervision of subcontractors, resulting in property damage. The company holds both a commercial general liability (CGL) policy and a professional liability errors and omissions policy. Which approach best guides the appraiser in determining the primary policy for coverage in this scenario? Option A. Focus solely on the professional liability policy. The allegation of negligent supervision implies a failure in professional oversight. Option B. Assume the claim is excluded from both policies due to the involvement of subcontractors and potential for complex liability. Option C. Conduct a thorough review of the commercial general liability policy to ascertain if the property damage falls within its scope, then assess the professional liability policy for any distinct professional errors or omissions. Option D. Prioritize the professional liability policy, as claims involving supervision often relate to professional services. The correct answer is D. Prioritize the professional liability policy, as claims involving supervision often relate to professional services. Explanation. This scenario is professionally challenging because it requires an appraiser to navigate the nuances of different liability policies and their application to a complex claim. The appraiser must not only understand the policy terms, but also how they interact with the specific facts of the loss, all while adhering to the regulatory framework governing insurance appraisals. Careful judgment is required to ensure the appraisal process is fair, accurate, and compliant. The correct approach involves a thorough review of the commercial general liability (CGL) policy to determine if the alleged damages fall within its scope, considering exclusions and definitions. This is because CGL policies are designed to cover bodily injury and property damage arising from business operations. The appraiser must then analyze the professional liability errors and omissions policy to ascertain if the claim pertains to a professional error or omission, which is typically excluded from CGL. This distinction is critical for accurate coverage determination and claim handling, aligning with regulatory expectations for diligent and competent claim investigation and appraisal. An incorrect approach would be to solely focus on the professional liability policy without first assessing the CGL. This fails to acknowledge that some claims might have elements that could trigger CGL coverage, even if professional liability is also implicated. Bypasses a fundamental step in liability coverage analysis and could lead to an incomplete or inaccurate appraisal. Another incorrect approach would be to assume the claim is automatically excluded from all policies without a detailed review of policy language and endorsements. This demonstrates a lack of due diligence and a failure to apply the policy terms to the specific facts, which is a violation of regulatory standards for fair claims handling. Professionals should employ a systematic decision-making framework that begins with a comprehensive understanding of the claim facts. This is followed by a detailed review of all potentially applicable insurance policies, starting with the broadest coverage, like CGL, and then examining more specialized policies, like professional liability. Each policy's terms, conditions, exclusions, and definitions must be meticulously applied to the claim facts. If ambiguity exists, regulatory guidance on interpreting policy language and the duty of good faith and fair dealing should be consulted. The appraisal process must be conducted with impartiality and a commitment to accurately reflecting the coverage provided by the policy. Question 4. Implementation of a new internal policy for insurance appraisers requires that all damage assessments be communicated to the insured and insurer within 48 hours of the initial inspection. During an inspection, an appraiser discovers significant structural damage that was not immediately apparent and requires further investigation by a specialized engineer. The appraiser has not yet received the engineer's report. Which of the following approaches best upholds the appraiser's professional obligations regarding representations? Option A. The appraiser communicates an estimated value for the visible damage within 48 hours, assuming the undisclosed structural damage will be minor and can be addressed later. Option B. The appraiser delays all communication to both parties until the engineer's report is received and a complete damage assessment can be provided, thereby exceeding the 48-hour internal policy. Option C. The appraiser communicates only the visible damage within 48 hours, omitting any mention of the potential for further undisclosed structural damage, to avoid alarming the insured or insurer prematurely. Option D. The appraiser communicates the initial findings of visible damage to both parties within 48 hours, clearly stating that a full assessment is pending the engineer's report, and that the initial communication is not a final valuation. The correct answer is D. The appraiser communicates the initial findings of visible damage to both parties within 48 hours, clearly stating that a full assessment is pending the engineer's report, and that the initial communication is not a final valuation. Explanation. This scenario presents a professional challenge because an insurance appraiser, acting as a fiduciary, is tasked with accurately representing the condition and value of damaged property to both the insured and the insurer. Misrepresenting facts, even unintentionally, can lead to disputes, financial losses for either party, and potential regulatory sanctions. The appraiser's duty is to provide an objective and truthful assessment based on their expertise and the evidence. Careful judgment is required to ensure all representations made are factual, supported by evidence, and communicated clearly and without ambiguity. The correct approach involves a thorough and objective assessment of the damage, documenting all findings meticulously, and then communicating these findings accurately to both the insured and the insurer. This ensures that all parties have a clear understanding of the property's condition and the basis for the appraisal. This approach aligns with the ethical obligations of an appraiser to act with integrity and honesty, and it adheres to the fundamental principles of insurance appraisal, which require a fair and impartial evaluation. Regulatory frameworks for insurance professionals typically mandate truthful and accurate representations in all dealings. An incorrect approach of downplaying the extent of damage to expedite the process is ethically and regulatorily unsound. This constitutes a misrepresentation of facts, potentially leading the insurer to offer a settlement that is insufficient for the insured to make full repairs. This violates the appraiser's duty of honesty and fairness. Another incorrect approach of exaggerating the damage to secure a higher appraisal value is equally problematic. This misleads the insurer and can result in an inflated claim, potentially leading to increased premiums for all policyholders and violating the appraiser's duty to provide an objective and fair valuation. Such actions can also lead to accusations of fraud or collusion. A third incorrect approach of omitting significant findings from the appraisal report, even if not explicitly lying, is a form of misrepresentation by omission. This prevents the insured and the insurer from having a complete picture of the damage, hindering fair resolution and potentially leading to disputes and regulatory scrutiny. The professional decision-making process for similar situations should involve a commitment to thorough investigation, objective analysis, and transparent communication. Appraisers must prioritize factual accuracy and ethical conduct above expediency or personal gain. When in doubt about the accuracy or completeness of a representation, it is always best to err on the side of caution, seek clarification, and ensure all information is verifiable and clearly communicated. Adherence to the specific regulatory guidelines governing insurance appraisers is paramount. Question 5. Which approach would be most appropriate for a certified insurance appraiser when interpreting policy language that appears to have multiple reasonable meanings, considering the stakeholder perspective of both the insured and the insurer? Option A. Seek clarification from the insurer on their intended meaning of the ambiguous language as they drafted the policy. Option B. Apply the interpretation that is most favorable to the insurer, assuming they have a superior understanding of policy construction. Option C. Rely solely on the insured's verbal explanation of what they believe the policy covers, regardless of the written terms. Option D. Interpret the ambiguous language in favor of the insured, as this aligns with the principle of construing insurance contracts against the insurer and upholding the insured's reasonable expectations. The correct answer is D. Interpret the ambiguous language in favor of the insured, as this aligns with the principle of construing insurance contracts against the insurer and upholding the insured's reasonable expectations. Explanation. This scenario is professionally challenging because it requires the certified insurance appraiser, CIA, to navigate potentially conflicting interpretations of policy language, balancing the insured's expectations with the insurer's contractual obligations. The appraiser must act with impartiality and uphold the integrity of the appraisal process, which is governed by specific state insurance regulations and the terms of the insurance contract. The core of the challenge lies in interpreting ambiguous policy language in a manner that is fair, consistent, and compliant with established legal and ethical standards. The correct approach involves a meticulous review of the policy language, considering established legal precedents and industry best practices for policy interpretation within the relevant jurisdiction. This approach prioritizes a thorough understanding of the contract's intent and the application of established rules of construction. Specifically, it requires the appraiser to consider the plain meaning of the words used, the context in which they appear, and any relevant definitions provided within the policy. If ambiguity persists, the appraiser must apply the principle of construing ambiguous language against the insurer, a common legal doctrine designed to protect policyholders. This aligns with the ethical duty of an appraiser to be fair and impartial, ensuring that the appraisal process serves its intended purpose of resolving disputes over the amount of loss based on a reasonable interpretation of the policy. Adherence to these principles ensures compliance with state insurance laws that mandate fair claims handling and prohibit deceptive practices. An incorrect approach would be to prioritize the insured's subjective understanding of coverage without a rigorous examination of the policy's actual wording. This fails to acknowledge that insurance policies are contracts with specific terms and conditions that define the scope of coverage. Relying solely on the insured's perception, without grounding it in the policy language, can lead to an appraisal that exceeds the contractual obligations of the insurer, potentially violating the principle of utmost good faith and leading to disputes over the appraisal award. Another incorrect approach would be to adopt the insurer's interpretation without independent, objective analysis, especially if that interpretation appears to unduly restrict coverage based on a strained reading of the policy. This would compromise the appraiser's impartiality and could violate the ethical obligation to conduct a fair and unbiased appraisal. Such an approach risks failing to uphold the reasonable expectations of the policyholder as established by the contract and applicable law. A further incorrect approach would be to introduce external factors or personal opinions not directly supported by the policy language or relevant legal principles. The appraisal process is focused on determining the amount of loss under the terms of the policy, not on making subjective judgments or incorporating external considerations that are not contractually relevant. This can undermine the credibility of the appraisal and lead to challenges based on the appraiser exceeding their authority or acting outside the scope of the appraisal. Professional decision-making process for similar situations should begin with a comprehensive review of the insurance policy, identifying all relevant provisions, definitions, and exclusions. The appraiser must then research applicable state laws and regulations governing insurance policy interpretation and claims handling. Applying established rules of contract construction, the appraiser should analyze the language for clarity or ambiguity. If ambiguity is found, the appraiser must consider how courts in the jurisdiction typically resolve such ambiguities, often favoring the policyholder. Throughout this process, Maintaining strict impartiality and documenting all findings and reasoning is paramount. Question 6. The analysis reveals that a client is seeking insurance for a new business venture that involves investing in emerging technologies with the potential for significant financial gains, but also substantial capital loss. The client's primary concern is protecting their initial investment. Option A. Classify the risk as dynamic risk and recommend a policy that adjusts premiums based on market fluctuations. Option B. Classify the risk as pure risk and recommend standard property insurance. Option C. Classify the risk as speculative risk and advise that it is generally uninsurable. Option D. Classify the risk as static risk and suggest a long-term fixed policy. Correct answer is B. Classify the risk as pure risk and recommend standard property insurance. Explanation. This scenario is professionally challenging because it requires an appraiser to distinguish between different categories of risk and their implications for insurance coverage, a core competency for a certified insurance appraiser, CIA. Misclassifying risk can lead to incorrect coverage recommendations, potentially leaving the insured underinsured or overinsured, and violating professional standards. Careful judgment is required to apply the theoretical concepts of risk to a practical insurance appraisal context. The correct approach involves accurately identifying the type of risk presented by the scenario. Pure risk, which involves the possibility of loss or no loss, is generally insurable. Speculative risk, which involves the possibility of gain or loss, is typically not insurable. Static risk, which arises from unchanging circumstances, is generally predictable and insurable. Dynamic risk, which arises from changing circumstances, can be unpredictable and more challenging to insure. An appraiser must correctly categorize the risk to determine its insurability and the appropriate insurance response. An incorrect approach would be to broadly categorize all potential negative outcomes as insurable without considering the nature of the risk. For instance, assuming any potential financial detriment is a pure risk without evaluating if it also presents a speculative element, e.g., a business venture with potential for profit and loss, is a failure. Similarly, failing to differentiate between risks arising from stable conditions versus those from evolving ones can lead to misjudgments about the predictability and insurability of a loss. This demonstrates a lack of understanding of fundamental risk principles, which is a direct violation of the professional standards expected of a CIA. Professionals should approach such situations by first dissecting the scenario to identify all potential outcomes. Then, they must apply the definitions of pure versus speculative risk and static versus dynamic risk. The key is to determine if the risk presents only the possibility of loss pure, or also the possibility of gain speculative, and if the underlying conditions are stable or in flux. This systematic application of risk theory to the specific facts of the appraisal is crucial for making sound, ethically compliant, and professionally responsible recommendations. Question 7. The monitoring system demonstrates a significant and unexplained discrepancy in inventory levels over a 3-month period, coinciding with the departure of a key warehouse manager. The insurer has provided a crime insurance policy that covers employee dishonesty and theft, but includes an exclusion for losses resulting from inventory shortages due to poor record keeping or inadequate security measures. The insured is seeking to recover the value of the missing inventory. Which of the following approaches best aligns with the certified insurance appraiser's responsibilities under the policy and relevant regulatory frameworks for claims handling? Option A. Advise the insured that the loss is likely unrecoverable due to the inventory shortage exclusion, without further investigation into the specific cause of the shortage. Option B. Suggest that the insured pursue legal action against the former warehouse manager to recover the losses, as this is the primary responsibility of the insured. Option C. Recommend coverage for the full value of the missing inventory, assuming the discrepancy is a direct result of employee dishonesty given the timing of the manager's departure. Option D. Conduct a detailed investigation to determine the specific cause of the inventory discrepancy, correlating findings with policy terms, exclusions, and any available evidence of employee dishonesty or theft, while also assessing the adequacy of security measures and record-keeping practices. The correct answer is C. Recommend coverage for the full value of the missing inventory, assuming the discrepancy is a direct result of employee dishonesty given the timing of the manager's departure. Explanation. This scenario is professionally challenging because it requires the appraiser to navigate the complexities of crime insurance policy interpretation and evidence assessment, particularly when dealing with potential internal fraud. The appraiser must remain objective and adhere strictly to the policy's terms and conditions, while also considering the insurer's obligations and the insured's claims. The core challenge lies in distinguishing between legitimate losses covered by the policy and those that may be excluded due to policy exclusions or the insured's actions or inactions. Careful judgment is required to ensure the appraisal process is fair, thorough, and compliant with regulatory expectations for insurance claims handling. The correct approach involves a meticulous review of all available evidence, including the monitoring system data, financial records, and any internal investigation reports. This approach prioritizes a factual and policy-driven assessment. It requires the appraiser to identify specific policy provisions related to employee dishonesty or other covered perils, and then to correlate the evidence with these provisions. The appraiser must also consider any policy exclusions that might apply, such as those related to lack of due diligence or collusion. This methodical process ensures that the appraisal is grounded in the policy's contractual obligations and relevant regulatory guidelines for claims investigation, promoting fairness and accuracy. An incorrect approach that focuses solely on the financial discrepancy, without a thorough investigation into the cause and coverage, would be professionally unacceptable. This failure stems from neglecting the fundamental requirement to establish that a covered peril, as defined by the crime insurance policy, has actually occurred. Bypasses the critical step of linking the loss to a specific policy provision, potentially leading to an inaccurate assessment of coverage. Another incorrect approach that relies on assumptions about employee misconduct without concrete evidence or a clear policy basis for such an assumption is also professionally flawed. This approach risks prejudging the situation and deviating from the objective, evidence-based appraisal process mandated by regulatory standards for claims handling. It fails to uphold the principle of due process for the insured and may violate the insurer's duty to investigate claims thoroughly and impartially. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the policy. Thoroughly review the crime insurance policy, paying close attention to definitions, covered perils, exclusion, and conditions precedent to recovery. 2. Gather and analyze evidence. Collect all relevant documentation, including the monitoring system data, financial statements, audit reports, and any internal investigation findings. Analyze this evidence objectively to identify patterns, anomalies, and potential causes of loss. 3. Correlate evidence to policy provisions. Determine if the gathered evidence supports a claim under a specific covered peril of the policy. Simultaneously, assess if any policy exclusions are applicable. 4. Document findings. Maintain detailed records of all evidence reviewed, analyses performed, and conclusions reached. This documentation is crucial for justifying the appraisal outcome and demonstrating compliance. 5. Maintain objectivity and impartiality. Throughout the process, remain neutral and avoid making assumptions or drawing conclusions not supported by evidence and the policy terms. Question 8. Process analysis reveals that a certified insurance appraiser, CIA, is evaluating a claim for a damaged antique piece of furniture. The policyholder insists the item's value is significantly higher than the appraiser's initial assessment, citing sentimental value and a unique provenance. The policyholder is becoming increasingly agitated and is demanding the appraiser immediately agree to their valuation to resolve the claim quickly. Which of the following represents the most appropriate professional approach for the CIA in this situation? Option A. Acknowledge the policyholder's emotional distress and explain that while sentimental value cannot be compensated under the policy, the appraisal will proceed based on the item's actual cash value or replacement cost as defined by the policy, supported by objective market data and industry standards. Option B. Immediately agree to the policyholder's valuation to de-escalate the situation and ensure a swift resolution, as the policyholder's satisfaction is the primary goal. Option C. Advise the policyholder that the appraisal process is solely for the insurer's benefit and that their input is not required or considered in the final valuation. Option D. Inform the policyholder that their valuation is irrelevant and proceed with an appraisal based solely on the appraiser's personal opinion of value, without further discussion or evidence. The correct answer is A. Acknowledge the policyholder's emotional distress and explain that While sentimental value cannot be compensated under the policy, the appraisal will proceed based on the item's actual cash value or replacement cost as defined by the policy, supported by objective market data and industry standards. Explanation. Scenario analysis. This scenario presents a common challenge for insurance appraisers where a policyholder's subjective perception of value conflicts with objective market realities and the terms of the insurance contract. The appraiser must navigate this conflict while upholding their professional duty to provide an unbiased assessment, adhering strictly to the policy's conditions and relevant regulatory guidelines for appraisers. The challenge lies in managing the emotional aspect of the claim, while maintaining professional objectivity and ensuring fair resolution based on established principles. Correct approach analysis. The correct approach involves a thorough review of the insurance policy's appraisal clause, a detailed inspection of the damaged property, and an objective assessment of its pre-loss condition and market value based on verifiable data and industry standards. This aligns with the fundamental insurance principle of indemnity, which aims to restore the insured to their pre-loss financial position, no more and no less. Regulatory frameworks for insurance appraisers typically mandate impartiality, adherence to policy terms, and the use of sound appraisal methodologies. By focusing on these elements, the appraiser fulfills their contractual and ethical obligations to both the insured and the insurer, ensuring a fair and defensible valuation. Incorrect approaches analysis. One incorrect approach would be to immediately concede to the policyholder's valuation simply to expedite the claim and avoid conflict. This fails to uphold the principle of indemnity, potentially overpaying the claim and violating the insurer's contractual rights. It also disregards the appraiser's duty of impartiality and adherence to policy terms, which are often subject to specific regulatory oversight. Another incorrect approach would be to dismiss the policyholder's concerns outright without a thorough investigation or explanation. While objectivity is crucial, a complete disregard for the insured's perspective can lead to accusations of bad faith and may violate regulatory requirements for fair claims handling and communication. The appraiser must demonstrate a diligent and considered process. A third incorrect approach would be to rely solely on the policyholder's provided documentation or opinions without independent verification or comparison to market data. This compromises the integrity of the appraisal process and fails to meet the professional standard of conducting an objective and evidence-based valuation. It also risks misinterpreting policy coverage or valuation methods, leading to an inaccurate and potentially disputed outcome. Professional reasoning. Professionals should approach such situations by first understanding the specific appraisal clause within the insurance policy. This clause dictates the process and scope of the appraisal. Next, they must conduct a comprehensive and objective inspection, gathering all relevant evidence, including photographs, measurements, and expert opinions if necessary. This evidence should then be analyzed against established valuation methodologies and market comparables. Throughout the process, clear and professional communication with both the insured and the insurer is paramount, explaining the methodology and findings transparently. If disagreements arise, the appraiser should refer back to the policy terms and relevant regulations to guide their decision-making, always prioritizing fairness and accuracy. Question 9. Cost-benefit analysis shows that implementing a more rigorous pre-loss valuation methodology for damaged automobiles, even if it requires more initial appraiser time, ultimately leads to more accurate and defensible settlement outcomes. Considering this, which of the following approaches best aligns with the principles of automobile liability insurance and regulatory expectations for fair claims handling? Option A. Prioritize obtaining the lowest repair estimate to minimize immediate payout, regardless of the vehicle's pre-loss condition or market value. Option B. Conduct a detailed assessment of the vehicle's pre-loss condition and market value, then compare this to the cost of repairs to determine if the vehicle is a total loss, ensuring the settlement reflects the actual cash value. Option C. Automatically classify any vehicle with damage exceeding 75% of its estimated repair cost as a total loss without further detailed appraisal. Option D. Focus solely on the cost of parts and labor for repairs, without factoring in the vehicle's overall market desirability or condition prior to the loss. The correct answer is A. Prioritize obtaining the lowest repair estimate to minimize immediate payout, regardless of the vehicle's pre-loss condition or market value. Explanation. Scenario analysis. This scenario presents a professional challenge for an insurance appraiser by requiring them to balance the financial interests of the insurer with the fair and equitable treatment of the insured, particularly when dealing with a vehicle that has sustained significant damage. The appraiser must navigate the complexities of determining the actual cash value, ACV, of a damaged automobile, considering factors that might not be immediately apparent or easily quantifiable. The challenge lies in accurately assessing the vehicle's pre-loss value and the extent of the damage, ensuring that the settlement reflects the true market value and not just the cost of repairs, while adhering strictly to the policy terms and applicable regulations. Correct approach analysis. The correct approach involves a thorough assessment of the vehicle's pre-loss condition, including its make, model, year, mileage, options, and overall condition, to establish its actual cash value, ACV. This is then compared to the cost of repairs. If the cost of repairs approaches or exceeds the ACV, the vehicle is likely a total loss. The appraiser must then determine the ACV based on comparable vehicles in the local market, factoring in any applicable deductions for depreciation or betterments. This aligns with the fundamental principles of automobile liability insurance, which aim to indemnify the insured for their loss, restoring them to their pre-loss financial position, as mandated by regulatory frameworks that govern fair claims handling and valuation. Specifically, regulations typically require insurers to pay no less than the ACV of the damaged property, less any applicable deductible. Incorrect approaches analysis. An approach that solely focuses on the lowest repair estimate without considering the vehicle's pre-loss value or market comparability is ethically and regulatorily flawed. This can lead to an undervaluation of the loss and an unfair settlement for the insured, potentially violating regulations that mandate fair and prompt payment of claims. Another incorrect approach would be to automatically declare a vehicle a total loss based on a predetermined percentage of the ACV, without a detailed appraisal of the damage and its repairability. This can result in unnecessary payouts for the insurer and the loss of a perfectly repairable vehicle for the insured, failing to meet the principle of indemnification. Furthermore, ignoring or misrepresenting the vehicle's condition or market value to achieve a lower settlement is a direct violation of ethical conduct and regulatory requirements for good faith claims handling. Professional reasoning. Professionals in this field must adopt a systematic and objective approach. This involves 1. Understanding the policy provisions thoroughly. 2. Conducting a comprehensive inspection of the damaged vehicle. 3. Researching comparable vehicles to establish a reliable ACV. 4. Obtaining and evaluating repair estimates, considering the quality of parts and labor. 5. Applying depreciation and betterment deductions fairly and transparently. 6. Communicating the appraisal findings clearly and professionally to both the insured and the insurer. This process ensures compliance with regulatory mandates for fair claims settlement and upholds the ethical duty to act with integrity and in the best interest of all parties involved, within the bounds of the insurance contract. Question 10. Risk assessment procedures indicate a property damage claim involves both a direct physical loss to a commercial building and a separate liability claim alleging negligence by the insured that contributed to the loss. As a certified insurance appraiser, CIA, you have been assigned to assess the physical damages to the building. The insured's legal counsel has inquired about your assessment of whether the insurer has a duty to defend the insured in the liability lawsuit, suggesting your findings on the cause of damage might be relevant. Which of the following represents the most appropriate course of action for the appraiser? Option A. Provide a detailed, factual report solely on the observed physical damages and their estimated repair costs, without commenting on the liability claim or the insurer's duty to defend. Option B. Include speculative language in your appraisal report, suggesting that the estimated repair costs should be adjusted to account for potential litigation expenses related to the liability claim. Option C. Offer an opinion to the insured's legal counsel regarding the insurer's duty to defend, based on your assessment of the cause of the physical damage. Option D. Refuse to conduct the appraisal until the liability claim is fully resolved, as the two are intertwined. The correct answer is A. Provide a detailed, factual report solely on the observed physical damages and their estimated repair costs, without commenting on the liability claim or the insurer's duty to defend. Explanation. This scenario presents a professional challenge because it requires the appraiser to navigate the complexities of liability insurance coverage, specifically concerning the duty to defend, without overstepping their defined role. The appraiser's primary responsibility is to accurately assess damages and costs related to a covered loss, not to interpret or adjudicate insurance policy coverage disputes, which falls under the purview of the insurer and legal counsel. Careful judgment is required to provide an objective assessment of the physical damage, while acknowledging the potential impact of liability claims on the overall claim resolution process, without making definitive coverage determinations. The correct approach involves meticulously documenting all observed damages and providing a detailed, factual report on the estimated repair or replacement costs. This approach is correct because it adheres strictly to the appraiser's mandate to provide an unbiased assessment of the physical loss. Regulatory frameworks for insurance appraisers, such as those governing the Certified Insurance Appraiser (CIA) designation, emphasize objectivity and adherence to the scope of the appraisal process. The appraiser's duty is to the facts of the damage, not to the legal interpretation of policy clauses like the duty to defend. By focusing solely on the damage assessment, the appraiser fulfills their contractual and ethical obligations without engaging in activities that could be construed as practicing law or making coverage decisions. An incorrect approach would be to offer an opinion on whether the insurer has a duty to defend the insured based on the observed damages. This is a legal determination that requires interpretation of policy language, case law, and the specific facts of the liability claim, all of which are outside the appraiser's expertise and authority. Such an opinion would constitute practicing law without a license and could lead to significant professional liability and regulatory sanctions. It also undermines the insurer's role in coverage analysis and potentially prejudices the insured by providing an unqualified assessment of their legal defense. Another incorrect approach would be to refuse to complete the appraisal report entirely due to the presence of a liability claim, arguing that the liability aspect makes the appraisal process too complex. While the liability claim adds complexity to the overall claim, it does not negate the appraiser's duty to assess the physical damages, assuming the underlying property damage is potentially covered. This refusal would be a breach of the appraisal agreement and could result in penalties for failing to perform their contracted duties. It also fails to recognize that the appraiser's role is distinct from the insurer's coverage determination. A third incorrect approach would be to include speculative language in the appraisal report that suggests the liability claim might influence the valuation of the physical damages beyond what is directly observable. For instance, suggesting that the cost of repairs should be inflated to account for potential litigation expenses or punitive damages related to the liability claim. This is incorrect because it conflates the assessment of physical damage with the resolution of a separate liability matter. The appraisal is for the cost of repair or replacement of the damaged property, not for the costs associated with defending a lawsuit. Such an approach would be biased, unethical, and would violate the principles of objective appraisal. The professional decision-making process for similar situations should involve a clear understanding of the appraiser's defined role and limitations. When faced with a scenario involving both property damage and a liability claim, the appraiser must first identify their specific task, assessing physical damages. They should then proceed with that task objectively and factually. If the liability claim introduces complexities that directly impact the scope or cost of repairing the physical damage, e.g., damage caused by a specific negligent act that requires a particular repair method, the appraiser should document these facts and their impact on the repair cost. However, any interpretation of policy coverage, duty to defend, or legal liability must be explicitly avoided. When in doubt, consulting with the assigning party, usually the insurer, about the scope of the appraisal and any potential overlaps with the liability investigation is a prudent step. But this consultation should focus on clarifying the appraisal scope, not on seeking guidance on legal matters. Question 11. Consider a scenario where an insurance appraiser is tasked with evaluating damage to a commercial property following a severe hailstorm. The property owner, while providing access and initial documentation, expresses significant concern about the potential impact on their business operations and emphasizes the need for a swift resolution to minimize downtime. The appraiser observes visible hail damage to the roof and siding, but the property owner also suggests that internal water damage may have occurred due to the storm, though no immediate signs are apparent during the initial walkthrough. The appraiser has a history of working with this particular insurance company and is aware of their preferred vendors for repairs. Which of the following approaches best upholds the principle of utmost good faith in this situation? Option A. Conduct a thorough inspection of all visible exterior damage, document findings with photographs and notes, and then request specific information from the property owner regarding any suspected internal water damage, outlining the need for further investigation if evidence emerges. Option B. Prioritize the property owner's stated concerns about business interruption and potential internal damage by immediately estimating a higher repair cost to expedite the claim, even if the full extent of internal damage is not yet confirmed. Option C. Focus primarily on documenting the visible exterior damage that is clearly attributable to the hailstorm, while downplaying the property owner's concerns about potential internal water damage due to the lack of immediate visual evidence. Option D. Immediately recommend the insurance company's preferred roofing contractor to begin repairs on the visible exterior damage, assuring the property owner that the contractor can also assess for any potential internal issues during the repair process. The correct answer is A. Conduct a thorough inspection of all visible exterior damage, document findings with photographs and notes, and then request specific information from the property owner regarding any suspected internal water damage, outlining the need for further investigation if evidence emerges. Explanation: this scenario is professionally challenging because it requires the appraiser to balance the insured's desire for a favorable outcome with the insurer's right to a fair assessment, all while upholding the principle of utmost good faith. The appraiser acts as a neutral third party, and their judgment directly impacts the resolution of a potentially contentious claim. Navigating this requires a deep understanding of the appraiser's ethical obligations and regulatory responsibilities. The correct approach involves a thorough and objective assessment of the damage, supported by credible evidence and industry-standard appraisal practices. This aligns with the principle of utmost good faith by ensuring that both parties receive a fair and unbiased evaluation of the loss. Regulatory frameworks for insurance appraisers emphasize transparency, accuracy, and impartiality. By adhering to these principles, the appraiser fulfills their duty to act honestly and fairly, preventing misrepresentation or concealment of material facts. An incorrect approach that focuses solely on the insured's narrative without independent verification fails to uphold utmost good faith. This would be a breach of the appraiser's duty to be impartial and could lead to an inflated or inaccurate valuation, potentially misleading the insurer and violating their right to a fair assessment. Similarly, an approach that prioritizes minimizing the payout to the insurer, regardless of the actual damage, also violates utmost good faith. This demonstrates bias and a failure to conduct a comprehensive and objective appraisal, potentially leading to underpayment of a legitimate claim. Professionals should approach such situations by first establishing clear communication protocols with both the insured and the insurer. They must then conduct a meticulous inspection, documenting all findings with objective evidence. Any assumptions or estimations must be clearly identified and justified. The appraisal report should be factual, comprehensive, and free from bias, reflecting a diligent effort to determine the true extent of the loss, according to policy terms and industry standards. This systematic and ethical process ensures that the appraisal serves its intended purpose of facilitating a fair resolution. Question 12. Strategic planning requires that certified insurance appraisers, CIAs, integrate risk management principles into their claims handling processes. When assessing a property damage claim, what is the most effective approach for a CIA to ensure that the risk management process, identification, assessment, control, and monitoring, is adequately addressed? Option A. Focus exclusively on calculating the immediate repair or replacement costs for the damaged property, deferring any risk-related considerations to a later stage or a different department. Option B. Defer all risk assessment responsibilities to a specialized risk management team, providing them only with the final repair cost estimates without any initial observations on potential risks. Option C. Conduct a rapid, superficial assessment of potential risks to expedite the claims process, ensuring only that a risk is noted without detailed documentation or analysis. Option D. Proactively identify and document potential underlying risks and contributing factors during the initial property damage assessment, and communicate these findings to relevant internal departments for further action. The correct answer is D. Proactively identify and document potential underlying risks and contributing factors during the initial property damage assessment, and communicate these findings to relevant internal departments for further action. Explanation. This scenario presents a professional challenge because it requires an insurance appraiser to balance the immediate need for efficient claims processing with the long-term imperative of robust risk management, all while adhering to the specific regulatory framework governing the Certified Insurance Appraiser (CIA) exam. The pressure to expedite claims can lead to shortcuts that compromise the thoroughness of risk identification and assessment, potentially exposing the insurer and policyholders to future losses. Careful judgment is required to ensure that risk management is integrated into the appraisal process, not treated as a separate, secondary task. The correct approach involves proactively integrating risk identification and assessment into the initial stages of the appraisal process. This means that, as an appraiser examines damaged property, they should not only quantify the loss, but also identify potential underlying causes or contributing factors that represent ongoing or future risks. This aligns with the fundamental principles of insurance, which are based on risk transfer and management. Regulatory guidance for CIA professionals emphasizes a duty of care to both the insurer and the insured, which includes ensuring that claims handling contributes to a sound risk profile for the insurer. By identifying and documenting these risks, the appraiser provides valuable information that can inform underwriting decisions, loss prevention strategies, and future policy terms, thereby fulfilling their professional obligations. An incorrect approach that focuses solely on the immediate repair cost without considering underlying risks fails to meet the comprehensive responsibilities of a CIA. This approach neglects the identification and assessment phases of the risk management process. Ethically, it can lead to a situation where similar future losses are not prevented, potentially increasing premiums for all policyholders, or leading to claim denials in the future due to unaddressed systemic issues. From a regulatory standpoint, this oversight could be viewed as a failure to exercise due diligence in managing the insurer's risk exposure. Another incorrect approach that involves deferring all risk assessment to a separate department without any initial appraisal input is also problematic. While specialized risk management teams are crucial, the appraiser is often the first point of contact with the physical evidence of a loss. Their observations are critical for initiating the risk assessment process. Failing to capture this initial information at the source means that valuable context and early warning signs may be lost, hindering the effectiveness of subsequent risk management efforts. This can be seen as a failure to contribute to the overall risk management framework of the insurer. Finally, an approach that prioritizes speed over accuracy in documenting potential risks, leading to vague or incomplete risk descriptions, is also flawed. While efficiency is important, the purpose of risk identification is to provide actionable information. Inaccurate or superficial documentation renders the risk assessment process ineffective, as it does not provide sufficient detail for mitigation strategies to be developed. This can lead to continued exposure to identified risks and a failure to uphold the professional standards expected of a CIA. The professional decision-making process for similar situations should involve a structured approach to risk management within the appraisal workflow. This includes 1. Actively looking for indicators of potential risks during the inspection. 2. Documenting these observations clearly and comprehensively. 3. Communicating these findings to the appropriate internal stakeholders within the insurance company. And 4. Understanding that risk management is an ongoing process that begins with the initial assessment of a loss. Question 13. Cost-benefit analysis shows that expediting the appraisal process by relying on a previous unrelated appraisal report for a similar property, without conducting a new, independent inspection of the current loss, would save significant time and resources. However, this approach carries the risk of misrepresenting the current damage and its true cost. Considering the legal liabilities faced by a certified insurance appraiser, CIA, in the U.S. regulatory framework, which of the following approaches best mitigates these risks and upholds professional obligations? Option A. Conduct a thorough, independent inspection of the current loss, meticulously documenting all damages directly attributable to the covered peril, and applying industry-standard appraisal methods in accordance with the policy's terms and conditions. Option B. Exclude any damages that appear to fall into ambiguous policy language, deferring coverage decisions to the insurer and focusing only on clearly defined damage. Option C. Accept the insured's provided repair estimates at face value, as they represent the insured's perceived cost of restoration, and incorporate them directly into the appraisal. Option D. Expedite the appraisal by utilizing a previous unrelated appraisal report for a similar property, assuming the damage is comparable and adjusting only for minor discrepancies. The correct answer is A. Conduct a thorough, independent inspection of the current loss, meticulously documenting all damages directly attributable to the covered peril, and applying industry-standard appraisal methods in accordance with the policy's terms and conditions. Explanation. Scenario analysis. This scenario presents a professional challenge because the Certified Insurance Appraiser, CIA, is tasked with determining the scope of damage and its associated costs, which directly impacts the insurer's financial liability and the insured's recovery. The appraiser must navigate potential conflicts of interest, uphold professional standards, and adhere strictly to the regulatory framework governing insurance appraisals. The core challenge lies in balancing the need for accurate assessment with the potential for external pressures or personal biases to influence the outcome, thereby risking legal liability for negligence or breach of fiduciary duty. Correct approach analysis. The correct approach involves a thorough, objective, and documented assessment of all damages directly attributable to the covered peril, utilizing industry-standard appraisal methods and adhering to the policy's terms and conditions. This approach is justified by the CIA's professional obligation to act with integrity and competence, as mandated by the Certified Insurance Appraiser, CIA, exams governing regulations. Specifically, these regulations emphasize impartiality, accuracy, and adherence to contractual obligations. By focusing solely on the policy-covered damage and employing established appraisal techniques, the appraiser minimizes the risk of over- or undervaluation, thereby protecting both the insurer from undue claims and the insured from inadequate compensation. This meticulous and unbiased process is the bedrock of avoiding legal liability for negligence or bad faith. Incorrect approach is analysis, an approach that prioritizes expediency by relying on a previous unrelated appraisal report without independent verification fails because it neglects the fundamental duty of due diligence. This bypasses the requirement for a current, specific assessment of the loss, potentially leading to an inaccurate valuation and exposing the appraiser to liability for negligence. Insurer and insured are entitled to an appraisal based on the facts of the current loss, not a presumption based on past events. Another incorrect approach, which involves accepting the insured's inflated repair estimates without critical review, constitutes a failure to act impartially and competently. This can lead to overpayment of claims, exposing the insurer to financial loss, and potentially implicating the appraiser in a breach of their professional duty to provide a fair and accurate valuation. Such an action could be construed as a failure to exercise reasonable care and skill, an approach that excludes certain damages based on a subjective interpretation of policy language, without consulting relevant legal counsel or established industry interpretations, is also professionally unsound. This can result in an underappraisal of the loss, leading to a dispute with the insured and potential legal action for breach of contract or bad faith. The appraiser's role is to assess the physical damage and its cost, not to make definitive legal interpretations of policy coverage without proper guidance. Professional reasoning. Professionals in this role must adopt a decision-making process that begins with a clear understanding of the governing policy and applicable regulations. The process should involve a systematic inspection of the damaged property, meticulous documentation of all findings, and the application of objective appraisal methodologies. Any reliance on external information, such as previous reports or estimates, must be critically evaluated and verified. When in doubt about policy interpretation or complex damage assessments, seeking guidance from legal counsel or subject matter experts is paramount. The ultimate goal is to produce a fair, accurate, and defensible appraisal that upholds professional integrity and minimizes legal exposure. Question 14. The performance metrics show a trend of slightly lower average claim payouts for properties appraised by you compared to other appraisers on the panel, particularly in cases involving significant water damage. Your insurer client has informally expressed satisfaction with this trend, suggesting it aligns with their cost containment goals. You are currently appraising a property with extensive water damage from a recent storm, and the initial assessment indicates substantial repair costs, but you recall a similar, albeit less severe, water damage claim you appraised last year, where the insurer was particularly pleased with the final payout. What is the most ethically and professionally sound approach to appraising the current property with extensive water damage? Option A. Seek to understand the insurer's specific cost containment targets for this claim, and adjust your damage assessment to meet those targets, even if it means deviating from a full and accurate representation of the loss. Option B. Prioritize identifying only the most obvious and easily quantifiable damages, omitting less apparent but potentially significant issues to expedite the appraisal process and align with the observed payout trend. Option C. Conduct a thorough and unbiased appraisal, meticulously documenting all covered damages and estimating repair costs based on current market rates and policy provisions, regardless of past performance metrics or informal client feedback. Option D. Focus on the types of repairs that were deemed acceptable in the previous water damage claim, potentially downplaying the extent of current damage to maintain a similar payout trend. The correct answer is C. Conduct a thorough and unbiased appraisal, meticulously documenting all covered damages and estimating repair costs based on current market rates and policy provisions, regardless of past performance metrics or informal client feedback. Explanation: this scenario is professionally challenging because it pits the appraiser's duty to accurately assess property damage against potential pressure to minimize claim payouts, which can impact client relationships and future business. The appraiser must navigate this conflict while upholding their ethical obligations and adhering to regulatory standards. The correct approach involves a thorough, unbiased, and documented assessment of all covered damages. This means meticulously inspecting the property, identifying the scope of loss, and estimating repair or replacement costs based on current market rates and policy terms. This approach is ethically sound and regulatorily compliant because it prioritizes accuracy and fairness. The Certified Insurance Appraiser (CIA) designation implies a commitment to professional standards that mandate impartiality and a duty to represent the facts of the loss truthfully. Adhering to the policy's terms and conditions and providing a detailed, evidence-based report ensures that the insured receives a fair settlement and that the insurer fulfills its contractual obligations. This upholds the integrity of the appraisal process and the appraiser's professional reputation. An incorrect approach would be to selectively focus on damages that appear less severe, or to downplay the extent of the loss to align with the insurer's perceived desire for a lower payout. This is ethically problematic as it constitutes a misrepresentation of the facts and a breach of the appraiser's duty to provide an objective assessment. Regulatorily, it could violate provisions related to fair claims handling and accurate damage assessment. Another incorrect approach would be to inflate the estimated repair costs beyond reasonable market value or policy coverage. While this might benefit the insured in the short term, it is unethical as it is not a true reflection of the loss and could be considered fraudulent. It also violates the appraiser's obligation to act with integrity and to provide a fair and accurate valuation. A third incorrect approach would be to avoid a comprehensive inspection or to rely solely on information provided by one party without independent verification. This demonstrates a lack of due diligence and impartiality, which are fundamental ethical and professional requirements for an appraiser. It fails to meet the standard of care expected of a certified professional and could lead to an inaccurate and unfair outcome for all parties involved. Professionals should approach such situations by first understanding their ethical obligations as outlined by professional bodies and regulatory frameworks. This includes a commitment to honesty, integrity, impartiality, and competence. They should then meticulously document their findings, relying on objective evidence and industry-standard appraisal practices. When faced with conflicting pressures, they should refer to the policy terms, relevant statutes, and their professional code of conduct to guide their decision-making, always prioritizing accuracy and fairness. Question 15. Risk assessment procedures indicate that a client, who is the insured party, has expressed strong opinions about the value of their damaged property and has provided the appraiser with a curated selection of market data that supports their desired valuation. The client has also suggested specific areas of the property that the appraiser should focus on during the inspection, implying that other areas are less relevant. The appraiser is aware that a thorough inspection and independent market research might yield different conclusions. Which of the following approaches best upholds the appraisal process steps and the appraiser's professional obligations? Option A. Conduct a superficial inspection, relying heavily on the client's provided market data and their interpretation of the property's condition, and then prepare a report that largely reflects the client's expectations. Option B. Conduct a thorough inspection of the entire property, perform independent market research, analyze all relevant data objectively, and prepare a report based on these findings, while politely acknowledging the client's input but explaining the necessity of independent verification. Option C. Focus the inspection primarily on the areas suggested by the client, utilize the market data provided by the client, and adjust the analysis to align with the client's desired valuation, while mentioning the client's input in the report. Option D. Perform a comprehensive inspection and independent research, but then selectively present the findings in the report to emphasize data that supports the client's valuation, while downplaying or omitting contradictory evidence. The correct answer is B. Conduct a thorough inspection of the entire property, perform independent market research, analyze all relevant data objectively, and prepare a report based on these findings, while politely acknowledging the client's input but explaining the necessity of independent verification. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a favorable outcome and the appraiser's ethical and regulatory obligation to conduct an objective and unbiased appraisal. The appraiser must navigate the pressure to conform to the client's expectations while upholding the integrity of the appraisal process. Careful judgment is required to ensure that all steps of the appraisal process are executed impartially and in accordance with established standards. The correct approach involves meticulously documenting all findings during the inspection, conducting thorough and objective research into comparable properties and market conditions, performing a dispassionate analysis of the gathered data, and then preparing a comprehensive and factual report. This aligns with the core principles of the Certified Insurance Appraiser (CIA) exam's regulatory framework, which emphasizes accuracy, objectivity, and adherence to established appraisal methodologies. Specifically, regulatory guidelines for appraisers mandate that all appraisals be based on factual evidence and sound judgment, free from undue influence or bias. The reporting phase is critical for transparently communicating the appraiser's findings and the basis for their conclusions, ensuring that all parties understand the valuation. An incorrect approach would be to selectively present information during the research and analysis phases that favors the client's desired outcome, while downplaying or omitting data that contradicts it. This violates the ethical duty of impartiality and the regulatory requirement for a comprehensive and unbiased assessment. Such selective reporting misrepresents the true market value and undermines the credibility of the appraisal. Another incorrect approach would be to allow the client's suggestions regarding the scope of the inspection to dictate the appraiser's actions, potentially leading to an incomplete or superficial examination of the property. This compromises the integrity of the inspection phase, which is foundational to the entire appraisal. Regulatory standards require a thorough and independent inspection to identify all relevant factors affecting value. Failing to conduct independent research and instead relying solely on information provided by the client, even if seemingly helpful, is also an incorrect approach. This introduces a significant risk of bias and omits the appraiser's professional responsibility to verify information and conduct their own due diligence. The appraisal must be based on the appraiser's independent findings and analysis, not on information filtered or curated by a party with a vested interest. The professional decision-making process for similar situations should involve a clear understanding of the appraisal standards and ethical codes governing the profession. When faced with client pressure or suggestions that could compromise objectivity, the appraiser must 1. Reiterate their professional obligations and the importance of an unbiased appraisal. 2. Clearly communicate the scope of work and the methodologies that will be employed. 3. Document all interactions and any client input received. 4. If the client's requests fundamentally conflict with professional standards, the appraiser must be prepared to decline the assignment or proceed with extreme caution, ensuring that their independence is maintained and clearly communicated. Question 16. The control framework reveals that an insurance appraiser has been tasked with valuing a commercial property damaged by fire. The policy includes an 80% coinsurance clause, and the stated amount of insurance on the policy is $500,000. During the appraisal process, the appraiser determines the actual replacement cost value of the damaged property to be $750,000, 000. Which of the following approaches best reflects the appraiser's professional responsibility in applying the coinsurance clause? Option A. Apply the coinsurance penalty directly to the stated insurance amount, regardless of the appraised value. Option B. Calculate the amount of insurance that should have been carried based on the appraised value and the coinsurance percentage, and then determine if a coinsurance penalty applies to the claim settlement. Option C. Advise the policyholder that since the stated insurance amount exceeds the initial reported value, the coinsurance clause is not applicable. Option D. Recommend that the insurer pay the full stated amount of insurance, as the appraiser's role is solely to determine the damage amount and not the application of policy clauses. The correct answer is B. Calculate the amount of insurance that should have been carried based on the appraised value and the coinsurance percentage, and then determine if a coinsurance penalty applies to the claim settlement. Explanation. This scenario is professionally challenging because it requires an appraiser to navigate the complexities of coinsurance clauses, which are designed to ensure that property is insured to a certain percentage of its value, thereby preventing underinsurance and encouraging fair premium collection. The appraiser must not only accurately determine the property's value, but also understand how the coinsurance clause impacts the settlement process, especially when the reported value differs significantly from the actual appraised value. The core challenge lies in applying the coinsurance formula correctly and communicating its implications clearly to the policyholder and insurer, ensuring compliance with policy terms and regulatory expectations for fair claims handling. The correct approach involves accurately determining the actual cash value (AC), or replacement cost value (RCV), of the damaged property as the basis for applying the coinsurance clause. This aligns with the fundamental principle of indemnity in insurance, ensuring the policyholder is compensated for their loss up to the policy limits, while also upholding the insurer's right to enforce the coinsurance provision as agreed upon in the contract. Regulatory frameworks for insurance appraisers typically mandate adherence to policy terms and the use of sound appraisal methodologies. By correctly calculating the amount of insurance that should have been carried based on the appraised value and the coinsurance percentage, and then comparing it to the amount of insurance that was carried, the appraiser can accurately determine if a coinsurance penalty applies and to what extent. This ensures a fair settlement that reflects the policy's intent and avoids penalizing the insured unfairly, or allowing the insurer to benefit from a situation where the insured acted in good faith. An incorrect approach would be to solely rely on the reported insurance amount without verifying its adequacy against the appraised value. This fails to uphold the purpose of the coinsurance clause, which is to prevent underinsurance. It could lead to an overpayment by the insurer if the property is significantly undervalued for insurance purposes, or an underpayment to the insured if a penalty is incorrectly applied or ignored. Another incorrect approach would be to ignore the coinsurance clause entirely, assuming it is not applicable or is a matter solely for the insurer to address. This abdicates the appraiser's responsibility to provide a complete and accurate appraisal that considers all relevant policy provisions, potentially leading to disputes and regulatory scrutiny for failing to perform a comprehensive appraisal. A third incorrect approach would be to apply a penalty without a clear understanding of the policy's specific wording or the applicable jurisdiction's regulations regarding coinsurance calculations, potentially leading to an unfair outcome for either the policyholder or the insurer. Professional decision-making in such situations requires a thorough understanding of the insurance policy, including all endorsements and clauses like coinsurance. It involves meticulous valuation of the damaged property using accepted appraisal standards, and then applying the coinsurance formula precisely as stipulated in the policy and in accordance with regulatory guidelines. Transparency and clear communication with all parties involved are paramount to ensure understanding and agreement on the appraisal outcome and its implications for the claim settlement. Question 17. The control framework reveals that an appraiser is tasked with assessing damage to a client's home following a severe storm. The damage includes structural issues to the roof and walls, as well as damage to a collection of valuable artwork and antique furniture stored within the residence. The appraiser must determine the most appropriate approach to evaluating the loss, considering the typical coverage provided by different property insurance policy types. Which of the following approaches best aligns with the principles of accurate property insurance appraisal in this scenario? Option A. Assume the valuable artwork and antique furniture fall under an inland marine policy and conduct a separate appraisal solely for these items, disregarding the damage to the dwelling itself. Option B. Immediately apply the appraisal principles and coverage limitations of a commercial property policy, as valuable artwork and antique furniture suggest a business-related risk. Option C. Review the homeowner's policies, coverage a dwelling, and coverage C personal property sections. Assess the damage to both the structure and the personal property, and determine coverage based on the policy's terms and conditions. Option D. Focus exclusively on the structural damage to the dwelling, as this is the primary component of a homeowner's policy, and defer any assessment of personal property to a separate claims adjuster. The correct answer is D. Focus exclusively on the structural damage to the dwelling, as this is the primary component of a homeowner's policy, and defer any assessment of personal property to a separate claims adjuster. Explanation: this scenario is professionally challenging because it requires the appraiser to navigate the nuances of different property insurance policy types and their specific coverage limitations when assessing a loss. The appraiser must demonstrate a thorough understanding of what is typically included and excluded under homeowners, commercial property, and inland marine policies to accurately determine the scope of damage and the applicable coverage. This requires careful judgment to avoid over- or underinsuring the claimant, which has significant financial and ethical implications. The correct approach involves meticulously reviewing the specific policy declarations page and the policies, coverage a dwelling and coverage C personal property sections for a homeowner's policy, and then comparing these to the damage assessment. This approach is right because it directly addresses the core of the claim under the most likely applicable policy. For a homeowner's policy, the primary coverage for the dwelling and its contents is typically found in these sections. The appraiser must then consider if any of the damaged items fall under specific exclusions or limitations within the homeowner's policy, or if they might be better covered under a different policy type if the circumstances warrant. This aligns with the fundamental principle of insurance appraisal, to determine the extent of loss as defined by the insurance contract. Regulatory and ethical guidelines for appraisers mandate adherence to policy terms and conditions, ensuring fair and accurate claim handling. An incorrect approach that focuses solely on the dwelling structure without considering personal property coverage would be professionally unacceptable. This fails to acknowledge that homeowners' policies cover both the structure and the contents within it, and a comprehensive appraisal must assess damage to both. This oversight could lead to an incomplete appraisal, leaving the claimant undercompensated for damaged personal belongings, which is a violation of the appraiser's duty to accurately assess the full scope of covered loss. Another incorrect approach that attempts to apply commercial property policy provisions to a homeowner's claim is also professionally unacceptable. Commercial property policies are designed for business assets and have different coverage triggers, limits, and exclusions than homeowners' policies. Misapplying these provisions would result in a fundamentally flawed appraisal, misinterpreting the applicable contract, and potentially denying coverage that should be provided under the homeowner's policy. This demonstrates a lack of understanding of basic policy distinctions and a failure to adhere to the specific contract governing the loss. Finally, an approach that immediately assumes the loss is an inland marine claim without a clear indication that the damaged property fits the specific criteria for inland marine coverage, e.g., property in transit movable property, is also professionally unacceptable. Inland marine policies are specialized and cover risks not typically covered by standard homeowners or commercial property policies. Jumping to this conclusion without proper investigation and policy review indicates a failure to follow a logical and evidence-based appraisal process, potentially leading to misclassification of the claim and incorrect application of coverage. The professional decision-making process for similar situations should involve 1. Identifying the type of insurance policy in force. 2. Thoroughly reviewing the policy's declarations page and all relevant endorsements. 3. Carefully examining the policy's insuring agreements, exclusions, and conditions. 4. Conducting a detailed inspection of the damaged property. 5. Correlating the physical damage with the specific terms and conditions of the applicable policy. 6. Documenting all findings and conclusions with clear justification based on policy language and appraisal standards. Question 18. The audit findings indicate that an appraiser, when assessing a claim for a damaged piece of commercial equipment, considered 3 potential valuation methods: replacement cost, actual cash value, and agreed value. The insurance policy in question covers the equipment but does not explicitly state a preferred valuation method, and the equipment was several years old and had undergone normal wear and tear. Which valuation method should the appraiser have prioritized and why? Option A. Agreed value, as it provides a straightforward settlement based on a predetermined amount, simplifying the appraisal process. Option B. Actual cash value, as it accounts for depreciation and reflects the item's value at the time of loss, aligning with the principle of indemnity. Option C. Actual cash value, as it is the simplest method to calculate and therefore the most efficient for the appraiser. Option D. Replacement cost, as it ensures the insured can acquire a new, equivalent item to continue their business operations without interruption. Correct answer is B. Actual cash value, as it accounts for depreciation and reflects the item's value at the time of loss, aligning with the principle of indemnity. Explanation. This scenario presents a professional challenge because the appraiser must navigate the nuances of different valuation methods to accurately reflect the policy's intent and the insured's loss, while adhering strictly to the governing regulatory framework for the Certified Insurance Appraiser (CIA) exam. The challenge lies in selecting the most appropriate method when multiple could theoretically be applied, ensuring fairness and compliance. The correct approach is actual cash value (ACV). This method is correct because it aligns with the typical intent of most property insurance policies, which is to indemnify the insured for their actual loss. ACV accounts for depreciation, reflecting the value of the property at the time of the loss, not its cost to replace with a new item. This is often the default valuation method unless the policy explicitly states otherwise, and it prevents the insured from experiencing a windfall gain. Regulatory frameworks for insurance appraisers often emphasize fair and equitable settlement, which ACV best achieves in this context by considering the age and condition of the damaged item. An incorrect approach would be replacement cost, RC. This method is incorrect because it would likely over-indemnify the insured if the policy does not specifically stipulate RC coverage. RC pays the cost to replace the damaged property with a new item of like kind and quality, without deducting for depreciation. If the policy is based on ACV, using RC would violate the principle of indemnity and potentially lead to a payout exceeding the actual loss sustained. This could be seen as a regulatory failure if it results in an unfair settlement or a breach of policy terms. Another incorrect approach would be agreed value. This method is incorrect because it is typically used for unique or high-value items where determining ACV or RC is difficult or impractical. In this scenario, if the item is a standard piece of equipment with established depreciation schedules, agreed value would be inappropriate. It bypasses the standard valuation methods and relies on a predetermined value that may not accurately reflect the actual loss at the time of the incident, potentially leading to over- or underpayment, and thus a regulatory or ethical failure in fair claims handling. The professional decision-making process for similar situations involves a thorough review of the insurance policy to determine the governing valuation method. This is followed by an assessment of the damaged property to understand its condition and age. The appraiser must then apply the method stipulated in the policy, or the most appropriate method if the policy is silent but common practice dictates a specific approach, always prioritizing fair indemnity and regulatory compliance. Question 19. The audit findings indicate that an appraiser, when assessing a claim involving alleged negligence in the provision of professional services, focused primarily on the financial losses incurred by the claimant and made a preliminary determination of coverage based on the existence of a commercial general liability (CGL) policy, without a detailed review of the specific policy language for professional liability or errors and omissions (E&O) coverage, which approach best reflects the required regulatory compliance for this scenario. Option A. Conduct a thorough review of all applicable policies, including CGL, professional liability, and E&O, to ascertain the specific insuring agreements, exclusions, conditions, and definitions relevant to the claim, and then apply these terms to the facts of the alleged negligence. Option B. Focus solely on the existence of any liability insurance policy and interpret its terms in the most favorable light for the claimant to expedite the appraisal process. Option C. Prioritize the claimant's stated financial damages and recommend coverage based on the general understanding of liability insurance, without delving into the intricacies of specific policy wordings. Option D. Assume that the CGL policy provides comprehensive coverage for all types of liability claims, including those arising from professional services, and proceed with the appraisal based on this assumption. Correct answer is A. Conduct a thorough review of all applicable policies, including CGL, professional liability, and E&O, to ascertain the specific insuring agreements, exclusions, conditions, and definitions relevant to the claim, and then apply these terms to the facts of the alleged negligence. Explanation. This scenario is professionally challenging because it requires an appraiser to navigate the complexities of liability insurance policies, specifically commercial general liability, CGL, professional liability, and errors and omissions, E&O, while adhering strictly to the regulatory framework governing the Certified Insurance Appraiser, CIA, exam. The appraiser must demonstrate a nuanced understanding of how these policies respond to claims and the limitations of their coverage, all within the confines of the specified jurisdiction's laws and guidelines. Careful judgment is required to accurately assess the scope of coverage and avoid misrepresenting policy terms, which could lead to regulatory sanctions or professional liability. The correct approach involves meticulously reviewing the specific policy language of the CGL, professional liability, and E&O policies in question. This includes identifying the insuring agreements, exclusions, conditions, and definitions within each policy. The appraiser must then apply these terms to the facts of the claim to determine coverage. This approach is correct because it directly aligns with the fundamental duty of an insurance appraiser to provide an objective and accurate assessment based on the contractual obligations of the insurance policy and the governing regulations of the specified jurisdiction. Adherence to policy terms and conditions ensures that the appraisal process is fair, transparent, and compliant with regulatory expectations for professional conduct. An incorrect approach that focuses solely on the claimant's perceived damages without reference to the specific policy provisions would be professionally unacceptable. This failure stems from neglecting the contractual basis of insurance coverage. Liability policies are not open-ended promises to pay for all harm. They are contracts with defined limits and exclusions. Ignoring these contractual limitations constitutes a regulatory and ethical failure, as it misrepresents the insurer's obligations and potentially leads to an inaccurate appraisal. Another incorrect approach would be to assume that a single policy, such as CGL, automatically covers all types of liability claims, regardless of the nature of the alleged error or omission. This demonstrates a lack of understanding of the distinct coverage afforded by professional liability and E&O policies, which are specifically designed to address claims arising from professional services. Relying on a broad assumption rather than a detailed policy review is a significant regulatory and ethical lapse, as it fails to accurately assess the applicability of specialized coverages and their respective terms and conditions. A third incorrect approach would be to interpret policy exclusions in a manner that is overly broad or overly narrow, without considering established case law or regulatory interpretations within the specified jurisdiction. This can lead to either an unwarranted denial of coverage or an unwarranted extension of coverage beyond the policy's intent. Such misinterpretations are regulatory and ethical failures because they undermine the principle of good faith and fair dealing, and can result in disputes that are costly and damaging to all parties involved. The professional decision-making process for similar situations should involve a systematic review of all relevant policy documents, a thorough understanding of the claim facts, and a diligent application of policy terms and conditions. Appraisers must remain objective, avoid making assumptions, and consult relevant regulatory guidance and legal precedents within their jurisdiction when interpreting complex policy language. When in doubt, seeking clarification from legal counsel or the insurer is a prudent step to ensure accuracy and compliance. Question 20. Benchmark analysis indicates that a senior insurance appraiser, responsible for overseeing a team of junior appraisers, receives an appraisal report from a subordinate that appears to significantly undervalue a damaged property. The senior appraiser has previously noted minor inconsistencies in this subordinate's work, but has not implemented formal corrective training. The senior appraiser is aware that accepting the report as is could lead to a claim of underpayment by the policyholder, and that their own professional reputation and potential liability are at stake. Which of the following represents the most appropriate course of action for the senior appraiser to mitigate potential vicarious liability and uphold professional standards? Option A. Conduct a thorough review of the subordinate's appraisal, compare it against industry standards and comparable properties, and if discrepancies are found, require the subordinate to revise the report with specific guidance, documenting all steps taken. Option B. Inform the subordinate that their performance is unsatisfactory and that they will be solely responsible for any repercussions arising from this specific appraisal, without further review or intervention. Option C. Immediately approve the report to avoid delays and potential disputes with the subordinate, assuming the subordinate is ultimately responsible for their own work. Option D. Forward the report to the policyholder with a disclaimer stating that it was prepared by a junior appraiser and that the senior appraiser cannot guarantee its accuracy. The correct answer is C. Immediately approve the report to avoid delays and potential disputes with the subordinate, assuming the subordinate is ultimately responsible for their own work. Explanation. This scenario is professionally challenging because it requires an insurance appraiser to navigate the complexities of vicarious liability, specifically concerning the actions of a subordinate appraiser. The appraiser must understand their legal and ethical obligations to supervise and ensure compliance with regulatory standards, even when delegating tasks. The core of the challenge lies in distinguishing between direct negligence in supervision and the direct negligence of the subordinate, and understanding when the supervising appraiser can be held liable for the latter. The correct approach involves a thorough review of the subordinate's work, identifying any deviations from established appraisal standards and regulatory requirements, and then taking appropriate corrective action. This demonstrates due diligence in supervision and a commitment to upholding the integrity of the appraisal process. Specifically, the supervising appraiser must ensure that the subordinate's appraisal report is accurate, objective, and compliant with all applicable laws and industry guidelines. If deficiencies are found, the supervising appraiser has a professional and ethical duty to address them directly with the subordinate, potentially requiring revisions or further investigation, rather than simply accepting the report or passing the buck. This proactive stance mitigates the risk of vicarious liability by actively managing the quality and compliance of the work performed under their oversight. An incorrect approach would be to blindly accept the subordinate's report without independent verification, especially if there are red flags or known areas of weakness in the subordinate's performance. This failure to exercise reasonable supervision constitutes negligence and can lead to vicarious liability for the errors or omissions in the subordinate's appraisal. Another incorrect approach is to dismiss concerns about the subordinate's work without proper investigation, perhaps due to time pressures or a desire to avoid conflict. This demonstrates a disregard for professional standards and regulatory compliance, exposing the supervising appraiser to significant legal and ethical repercussions. Furthermore, attempting to shift blame entirely to the subordinate without acknowledging the supervising appraiser's own duty of oversight is a flawed strategy that ignores the principles of vicarious liability. The professional decision-making process for similar situations should involve a systematic evaluation of delegated tasks. This includes assessing the competence of the individual to whom the task is delegated, clearly communicating expectations and standards, and establishing a robust review process. When reviewing the work of a subordinate, appraisers should be vigilant for any signs of error, bias, or noncompliance. If issues are identified, the appraiser must take immediate and appropriate action, which may include requesting revisions, providing additional training, or, in severe cases, disassociating from the work. This layered approach ensures accountability and upholds the professional standards expected of insurance appraisers.